Hello and welcome to our YouTube video on the 10 Principles of Economics. Today, we will be discussing the key concepts of economics from the book Principles of Microeconomics by N. Gregory Mankiw. The first principle we'll explore is that people face trade-offs. This means that to achieve one thing, we have to give up something else. For instance, if you want to go out to a party, you may have to give up studying for an exam that's scheduled for the next day. Similarly, if a country wants to produce more guns, it must produce fewer butter. The second principle is that the cost of something is what you give up to get it. In other words, the opportunity cost of making a choice. For instance, if a company decides to invest in new machinery, the opportunity cost of that investment is the interest it could have earned if it had invested the same money in a bank. The third principle is that rational people think at the margin. This means that people make decisions by weighing the marginal costs and benefits of each additional unit. For instance, a company might decide to produce an additional unit of a product only if the marginal revenue it generates is higher than the marginal cost of producing it. The fourth principle is that people respond to incentives. This means that people will change their behavior if they are given the right incentives. For example, if the government offers tax breaks for investing in renewable energy, people might be more likely to invest in solar panels or wind turbines. The fifth principle highlights that trade can make everyone better off. This means that if a country allows the import of cheaper goods from another country, consumers can buy the goods at a lower price, while producers can sell more and earn more income. The sixth principle is that markets are usually a good way to allocate resources. This is because buyers and sellers are motivated by self-interest, and markets can allocate resources efficiently. For instance, if the price of a product increases, suppliers are motivated to produce more of it, while buyers are motivated to buy less. The seventh principle is that governments can sometimes improve market outcomes. This means that government intervention can sometimes improve the efficiency of markets. For example, the government might impose a tax on cigarettes to discourage smoking, which can help reduce the negative externalities associated with smoking. The eighth principle is that the standard of living depends on a country's production. This means that a country's income and standard of living depend on its ability to produce goods and services. For example, a country with a well-educated and skilled workforce is likely to have a higher standard of living than a country with a less educated workforce. The ninth principle explains that prices rise when the government prints too much money. This is because inflation occurs when the government prints too much money, which reduces the value of each unit of currency. For instance, if the government prints more money to pay off its debts, the value of the currency might decrease, leading to higher prices of goods and services. Finally, the 10th principle explains that society faces a short-run trade-off between inflation and unemployment. This means that there is an inverse relationship between inflation and unemployment. For example, if the government wants to reduce unemployment, it might increase the money supply, which can lead to inflation. Conversely, if the government wants to reduce inflation, it might reduce the money supply, which can lead to higher unemployment. So there you have it. These are the 10 principles of economics from the book Principles of Microeconomics by N. Gregory Mankiw. We hope you found this video helpful in understanding the basic concepts of economics. Thanks for watching, and don't forget to hit that like and subscribe button.